Good evening, ladies and gentlemen. It is always my pleasure to connect with you and to interact with you. Well, the objective of today's webinar is to discuss how do we see market from the current levels, because there are many questions in investors' minds that market is at all-time high, Sensex has touched 60,000 levels, and what next from current levels, because we are at all-time high levels. So there are a lot of questions in the minds of investors, and we thought it is appropriate to discuss our view. How do we see the market from here on, and also from the global perspective and from India perspective, what kind of steps we are taking. The agenda of the flow of this, the presentation is going to be like this: that how do we see market corrections? How do we see the earnings growth? How do we see the drivers of earnings growth? How do we see the valuations? Very important thing in this market. And last but not least, what is our PMS strategy? First and foremost, corrections are part of any normal bull market. We strongly believe that we are in a structural bull market. And if you look at even 2003 to 2008 period, when Sensex went up 5 times in 5 years, 5 times in 5 years, that is 500% returns. It means Sensex gave you 39% compounded returns. But that bull market was also not without corrections. In fact, 5 times to 6 times, Nifty corrected by more than 15%. So if you look at this chart, 2002, in month of January to July period, in between market corrected by 16%. Similarly, February to July 2003, market corrected by 19%. In 2004, the correction was as sharp as 33%. In fact, it changed die-hard bull market fans that this market is over. It went down by 33%. But after that, again, market continued to rally. And even if suppose one would have invested in 2004, market went down 33%, but he remained invested, and then what happened? The market went to the new highs. So corrections are part of any bull market. Corrections can be sharp at times, but what is more critically important is earnings growth. The answer to this question, that why despite 15, 20, 30% corrections during that time period, what made market going to the new high every month? And the answer lies in this chart. And if you look at this chart, the 2003 to 2008, Nifty gave 38% compounding returns because the earnings growth was 26% compounded for 5 years. Now that is something very, very big number to talk about. And if you look at last 12 years, the earnings growth of Nifty is just 6.5%. In fact, I say that it's like a winter for corporate India, Just 6.5% is actually very, very low, pathetic earnings growth. Because in an economy where real GDP growth is 5, 6, 7%, normally you expect corporate India to deliver 10, 12% earnings growth. But last 12 years was a winter for corporate India. There was no earnings growth. But from here on, we expect Nifty to deliver very strong earnings growth. And now let me explain you why we think that Nifty earnings growth can be very strong. The reasons for the earnings growth drivers are 4. Just a minute, let me put in the full mode. The first important thing is big is getting bigger. And I will explain you each driver of earnings growth and also the momentum of each driver. That's something very critical. Second, we talk about the corporate balance sheet. Thirdly, we talk about capex, very, very important pillar for any economic growth to sustain. And last but not least, the PLI and China plus one, what right now happening in the world. Let me take you the first very important thing, big is getting bigger. Friends, I'm sure all of you would remember that in last 18-24 months, and particularly from last, I would say from March 20 onwards, we talked about three important themes. And the first important thing what we talked about is the acceleration of formalization. This is nothing new. I think everybody knows in this room that demonetization, GST, RERA, bank crisis, the financial crisis because of IL&FS, all these things resulted into organized players getting more and more market share, and unorganized players, they are losing out slowly and steadily. But something changed, something further accelerated this process, and that is pandemic COVID related thing, which happened last year. And after that, there is a wave 2 in India from April to June, and simultaneously, unfortunately, one more thing hit the country hard, worldwide as well as in India, and that is supply chain bottlenecks. So till yesterday, we were talking about acceleration of formalization. It means unorganized to organized. But now we are talking about within organized players, big is becoming bigger. If a company is number 15, then the power of that company to get the supply chain in order is very, very weak, is extremely poor compared to number 1 or number 2 player. I'm sure many of you, being our investors, we know many of you are also into your own successful businesses, and many of you also might be facing difficulties in getting the containers, in getting the logistics supply chain resolved. And that's what is making difference between big and small players. The big companies in India across the sectors, they are gaining market share at the expense of not only unorganized players, but also at the expense of the small players. And these are the few examples. And if you look at the last column, it is nothing but the incremental market share in bank credit. The top 6 players, their market share has increased significantly in last 10 years. From 37%, it is now 67%. 67% of the incremental bank lending is by top 6 players. If you look at housing finance, 89% is driven by only top 2 players. If you talk about cement, the top 5 players, incremental market share is 100%. If you talk about steel, it is 95%. If you talk about general insurance, it is 75%. If you talk about domestic pharma, it is now 76%. And these are just a few examples we are highlighting here. And these are also examples where all data are available, because we are not getting data from the tiles and plywood and wires and cables and many more such other industries. But actually, Spain is much more into such sectors like plywood and tiles, wires, cables, pipes, and many other such sectors. The important question, and I will keep reconnecting to the dots, that I said very important thing at the beginning, that you need to take view on earnings growth. And that earnings growth is not for corporate India, listed, unlisted, SME put together. No. The earnings growth, what we need to predict is about those 200, 300, 400, 500 companies which contribute 90%, 95% to the market cap. Now just think through it. These are the companies which are listed in India, about 300, 400 top corporates. They are actually 95% of the market cap, and they are also the top 3, top 4, top 5 players in their industry. As the big is becoming bigger, naturally they are gaining more market share. And as they gain more market share, their revenue growth is definitely going to be higher than the nominal GDP growth. Second important driver is corporate India balance sheet. Never before such thing has happened that while on one hand the big is becoming bigger, on the other hand the balance sheet is becoming more efficient. What I mean by more efficient? It means low debt equity. It means the corporates are sitting on very low leverage in their balance sheet. And if you look at this chart, in FY20, if you look at the free cash flow, it was about 43,000 crores. And after that pandemic hit India, everybody thought that corporate India will require more debt But actually, the free cash flow went up significantly from 435 billion, it is 2,200 billion. Significant improvement in the underlying balance sheet. And as the free cash flow improved significantly, if you look at the net debt, it is actually reduced by almost 1,80,000 crores. That's a huge number. And that too in a pandemic year. And if you look at the last table on the right hand side corner, the incremental excluding Reliance and excluding software sector, the change is huge, 1,80,000 crores. And this is across sectors. It is not one particular company, it is not one particular sector. This is across sectors. The big players, they have unleveraged, they have deleveraged their balance sheet significantly. They have further focused on their working capital. They have improved their free cash flow despite very, very challenging pandemic year. And I still remember many of the investors, they were asking during last year, particularly June, July, August, then why the markets are going up when economy is not yet recovered? And our answer was very simple, that market is not rear view mirror driving, it is always front driving. And now look at it. The markets have gone up, but now it is easy to explain why market has gone up. Not only the earnings growth was 20% for Nifty for last year, but also the balance sheet of corporate India has improved significantly. And who would have thought this exactly 1 year back? Third important driver is the capex. The capital expenditure is a missing link in India for almost like last 10-12 years. The private sector capex is very, very muted in India. But the good thing is that the government, both central government and the state government, they both have continued to spend high on infrastructure. Whether it is road, whether it is railways, whether it is port, whether it is water, whether it is urban infra, their expenditure by and large, they remain much, much healthy shape despite at times stagnant Indian economy. And therefore, if you look at this chart is very, very critical for you to understand, because in this chart, what we are showing is this green bar, 1,284 billion, and compare this chart with a normal year. 20 was a pandemic year. But look at 2019. From 1,076 billion, now it is 1,284 billion. Almost like 20% growth. And that is true even for the state. The states also did 9 to 10% growth in their capex. Now capex is something very, very important, because currently the capacity utilization of Indian industry is at suboptimal levels, roughly about 65 to 69% depending upon different industries. On an average, it is 65 to 68%. But because of the government continued capex, it has maintained that high capex levels, utilization level of 68 to 69. But now it is going to move up significantly, and the reason is very important reason, because of the significant increase in commodity prices globally, and also because of the global underlying recovery. The key important sectors, if you look in India, they are power, steel, cement, and refinery. They have already announced the capex. So I'm not taking a bet that will it happen or not. There is no debate. They have already announced the large project across these 3, 4, 5.
You are not audible. You are not audible. Suddenly your voice has become very faint. I don't know if it's only me or other participants as well.
It is audible perfectly fine for me.
Fine for me as well. Okay.
Fine for me as well. Thank you. So key important industries like power, steel, cement, and refinery, they have already announced the large capital expenditure projects. And if you look at last 3 years, FY19, FY20, and FY21, the total capex was about 3,200 billion for these sectors. And if you look at the next 3 years, it is going to be 7,500 billion for these sectors. So, and these companies, the large companies within that, for example, if you talk about steel, Tata Steel, Steel Authority. If you talk about aluminium, it is Hindalco. If you talk about cement, it is Ultratech and Sri Cement. These companies' capex plans are already announced, and few of them have already started working on in terms of the execution. So there is a 132% jump in capex over next 3 years. So revival is a real revival. It is just not a hope. This time it is a real revival. And one last important thing which is further boosting this capex is the PLI scheme. Because if you look at this slide, I talked about here PLI 1400 billion. Out of this 7500 billion, 1400 billion is for PLI. And this PLI is already announced. In fact, if I'm not wrong, the number is further revised to almost 2000 billion instead of 1400 billion. And the sector-wise imports, everybody knows India imports big in auto and mobiles and pharma and telecom, and number of incentives have been given, and the capex plan is roughly about 2 lakh crores over next 2 to 3 years. China plus one is definitely a global thing. Everybody now knows about it. It is not China versus India. It is a China plus one. And global players, like last conference call also I was mentioning, and on an average we speak with one company a day, and every day when I talk with pharma company, chemical company, last week I was talking with one of the large FMCG company, every company is talking about sourcing more from India. One, of course, they are disturbed because of the constant volatility in Chinese policy. Second, they want to reduce the risk. Over dependence in China is definitely not a good thing from any large corporate perspective. The third, the labor cost in India are much lower compared to China. The fourth, the PLI scheme is an addition to their overall incentive, makes the project more viable. Fifth, the income tax rate for the newer unit is at 15%. That also helps you to get to that better payback period and better return on investment. All these things combined, that is resulting into large commitment by global players for the Indian subsidiaries or to the Indian vendors. And this is not restricted only to pharma and chemicals. This is across. I was talking with one of the largest company in capital goods, and they were also saying the same thing, that the parent company has identified the Indian company for the exports to the Latin American market and to the entire region. And now they are going to supply from India compared to earlier supply from some other region. So India is going to play very, very important role. Our market share is very, very low compared to China. So even if there is a 2, 3, 4, 5, 10% shift from China to India, for us it is enough. Because for that, our earnings growth instead of 10, 12, 13% will go up to 17, 18, 19, 20%, which is enough for us as an investors. Lastly, I was talking about the corporate profits and how the corporate winter was for almost like last 12 years. And if you look at this chart, the yellow line is CPI inflation and the blue bars are corporate profit to GDP. And again, if you look at 2003 to 2008 period, the corporate profit to GDP touched a high of 7.2%. And in FY20, it reduced to as low as 1.6%. Normally, the average corporate profit to GDP is roughly between 4 to 5%. The inflation, and I'm sure everybody in your mind will have one important concern, that what about inflation? And of course, nobody likes inflation. But the fact of the matter is, some inflation is good for economy. And if you look at the CPI index, it was very low in FY03. It started inching up, and corporate profit to GDP also inched up. But only when it became very high, then it proved to be dangerous, and then of course everything fell off, because very high inflation is definitely a dangerous thing. But a moderate inflation is definitely a good thing for any economy, and that true even for Indian economy, and that true even for corporate India. So just to summarize, the 4 reasons why we believe that corporate India, and I'm talking about a listed universe, I'm not talking about SME players, I'm not talking about agrarian economy. There might be stress in SME, there might be stress in very, very small companies, even though they might be listed or unlisted, but I'm talking about those 200, 300, 400 corporates. Just think through it. If the India GDP growth, real terms, is 5%, and if you add 5% inflation, it becomes 10%. The question what one needs to answer, do you think that corporate India, that 300, 400 companies I'm talking about, can they grow at least by 10% in revenue terms? Answer is very likelihood of them reporting 10 to 12%, because they are actually gaining market share. Economy may not grow at 10% in real GDP growth. Economy will continue to grow at only 5%. But the corporate India revenue growth can be higher than nominal GDP growth. So if you believe that nominal GDP growth is 10%, corporate India can deliver 11-12%. That is coming at a time when there is a deleverage in the balance sheet. It means that cost is under control, and therefore the profit growth can be higher than the revenue growth. And if the profit growth is higher than revenue growth, which is happening at a time when capex cycle is just about to turn around, and also PLI and China Plus One is working together, are we back to those golden days of 2003 to 2008, where the earnings growth is going to be very, very strong of 18, 20, 23, 24%. That period of 3-4 years can be a repeat of that golden period. We believe so. How much it can be? Can it be 18%? Can it be 25%? Nobody knows. The world is very volatile. But the direction is very clear that we are set for a very strong double-digit earnings growth. And if we are set for a strong double-digit earnings growth, and therefore market also has a potential to deliver good double-digit returns to the shareholders. Of course, no bull market is without correction, and this time is not going to be different. This time also will witness correction. How much? We don't know. When? We don't know. But will it last for 3 years, that correction? Definitely not. It will be short correction, possible at any point of time. But as a structurally, with a 3 to 5 years time frame, we are reasonably positive on Indian equity market as an asset class. The last important thing is about the valuations. If you look at last 10 years average, we are about 18.5. Currently, we are trading about 21.5 on FY23 basis, which in our mind is fair. We are not cheap, but we are not too expensive either. Given the strong earnings growth, we think the valuations can be sustained. What we are doing in our portfolio? 5 important themes. First is, of course, the banking, where we are having about roughly 25% of the weightage. And our approach here is winner takes it all, because the pain in the economy is not yet over. So we are not getting ourselves exposed to the small banks. We are primarily into the large institutions like HDFC, HDFC banks and ICICI banks kind of the companies. That's about banking. Second important theme is domestic play. We believe that Indian economy is going to recover very strongly post-COVID wave 2. Of course, wave 3 can come. We don't know how much and when, what kind of impact it can have. But hopefully, with strong vaccination drive, we believe that impact will be not that significant, unlike wave 1 and wave 2. And therefore, we are focusing on revival. About 20% of the portfolio is into companies which are into capex or cement or logistics, the companies which can benefit from the revival. Third important is China Plus One. As you are aware, we have been holding specialty chemical companies from last almost 3 to 4 years. We remain extremely bullish on this space. Specialty chemicals, electronics, pharmaceuticals, I'm talking about API export kind of companies. We remain very bullish on that theme. So that is chemicals. Fourth is exports. The global recovery is going to be much faster because there is spending power, and therefore focusing on companies which are into global auto ancillaries or which are into, say, global pharma companies supplying to the global customers and software and such sectors. And last but not least is the consumer. But within consumer, our focus right now is more on discretionary rather than defensives. So more on companies like Titan and Trent of the world rather than Nestle's of the world. So that's overall in terms of how do we see the overall portfolio construction. As you are aware, we always believed in buying the companies which are top 5 in the sector. Big is getting bigger is really helping our portfolio companies significantly in last 12-18 months, and they are continuing to gain market share as we are speaking. Whether it is a pipe company, whether it is a plywood company, whether it is a logistic companies, across our portfolio companies, being number 1 or number 2 is putting these companies at a significantly better competitive advantage. And they are gaining market share, and also in terms of the operating profitability, they are gaining further. Their balance sheet, most of our portfolio companies, as you are aware, they are net cash, and therefore they are much better positioned from the ROE and ROC perspective. One slide on earnings growth, because I always believe that earnings growth is something that is most critical. This is how our portfolio companies have performed. in last three critical quarters, 2Q, 3Q and 4Q of last year. Friends, just to rewind a little bit, second quarter last year, I'm sure you would remember, April to June was a complete lockdown. June onwards, economy started opening very, very slowly. It was like 50% operational economy. During that time, the Nifty reported degrowth in revenue. That's the red bar. And in that critical time, our portfolio companies delivered 9% positive revenue growth. In third quarter, when Indian economy almost fully opened up, Nifty reported 0% revenue growth, flat revenue because economy opened up. But at that time, our portfolio companies reported 17% revenue growth. Think of it. Economy 0%, our portfolio reported 17%. And in the fourth quarter, when Indian economy was running on high speed, Nifty reported 20% plus revenue growth, and this time our portfolio companies continue to report 24% revenue growth. Why such kind of high revenue growth despite lockdowns, despite economy not operating at 100% utilization? It's because our companies benefited not only from opening up of Indian economy, but there are the world-class cost structures, world-class business models. And that's helped them to gain more market share even globally as well as locally, because they are cost competitive with a very high efficient balance sheet. And that's the reason why our portfolio companies did significantly better than the Nifty in terms of revenue growth. These are our exposure in terms of sector-wise, which I already talked about. I'm sure all of you are aware in terms of our flexibility, we are very agile, and exit strategy is as important as entry strategy. And this is a demonstration how we change our portfolio allocation in last 18 months of COVID volatility. So when COVID entered India, we had about 20% cash levels. We raised 20% cash. After that, market corrected 30-40%. We deployed that cash, but we invested into defensives. Those stocks went up by 30-40-50%. By September, October, Indian economy opened up, and we reduced the exposure from defensive to cyclicals. Last slide, our portfolio characteristics. True multi-cap, 50% large cap, 25% mid cap, 25% small cap. All of our portfolio companies, they were large profit size. Bulk of them have a profit size of 100, 200, 300, 500, 1000 crores. To make 1000 crore profit, you require 10,000 crore of revenue. So portfolio companies are really large companies. And they have a balance sheet which are debt free. So you can imagine now that have a 5,000, 10,000 crore revenue. To remain debt free is a very, very difficult task. All our portfolio companies, 80% of the portfolio companies, they have zero debt. I'm sure a question will come to your mind that what makes them such a high efficient balance sheet? The answer is because they are market leaders. They are enjoying oligopolies or monopolies in their sector. And of course, they have a very strong earnings growth backed by very strong return on net worth. So that's it from my side, and I'm happy to answer any of your questions. I request you to please put your questions in the chat box. We have also received few questions through email, which also we will talk through it. Thank you once again for your valuable time, and happy to answer any of your questions.